Hi everyone, welcome to my channel. I am Doris and I'm here to share with you about my stock account and today's market performance. Today I lost $573 in my account, and also talking about expectations of slowing inflation pushed the S&P 500 index higher for a second straight week. Today, let's take a look at my account today. Right now, the net asset of my account is $84,565.89. I lost today, including the aftermarket, I lost $708 or 0.83%. And in total, my account has made a loss of $16,615.57. Right now, in my account, I'm still holding shares of 1,300 shares of SQQQ and 500 shares of DRV. Today, DRV rose 1.38% to $43.43, and SQQQ lost for 1.99% to $45.81. Let's take a look at the market today. Today, market showed a strong performance. All of the three market indexes showed a growth. S&P 500 rose for 0.4%. Nasdaq Composite rose for 0.71%, and Dow Jones Industrial Average rose for 0.33%. Looking at the industry heat map today, we can see that internet retail rose the most of 2.91%, and auto industry and aerospace and defense decreased the most for almost more than 1.5%. All of the three major indexes posted gains. Both the Nasdaq and the S&P 500 had their best week since November. The S&P 500 hosted its second straight weeks of gains. Jpmorgan Chase. Jpmorgan reported Friday beating fiscal fourth quarter revenue expectations, but warned the company has made more provisions for credit losses as a mild recession was at its base forecast. During the quarter, the bank posted $2.3 billion in credit loss reserves, up 49% from third quarter, while fourth quarter net interest income hit a record of $20.2 billion in the economy. The largest U.S. bank said it will be around $73 billion this year, below analysts' expectations of $74.4 billion. CEO Jamie Dimon said in a statement on Friday, the U.S. economy is currently remaining strong, with consumer cash-rich conditions and solid corporate conditions. We still wonder about the possible ultimate impact of negative factors like geopolitical tensions, fragile energy and food supplies, persistent inflation, and unprecedented quantitative tightening. It also warned of a slightly deteriorating macroeconomic outlook. Wells Fargo posted its earnings for the fourth quarter of 2022, despite warnings last month of significant losses related to regulatory sanctions. Wells Fargo announced $16.2 billion in the fourth quarter, beating analysts' expectations. $3.3 billion operating loss in the fourth quarter. Wells Fargo said last month that it would include a cost of a settlement with the Consumer Financial Protection Bureau and the implications of other legal issues. One bright spot: Wells Fargo's net interest income hit a record of $13.4 billion, up 45% in the quarter, easily beating analysts' expectations. Chief Executive Charlie Scharf said in a statement, "Despite the previous disclosure of operating losses, but our basic performance reflects our progress in improving returns, rising interest rates to boost net interest income. Credit losses continue to increase slowly, but the credit quality is still strong. We'll continue to make progress in efficiency." Bank of America traders performed better than analysts expected, benefit from wild market volatility, and lending yields rose along with interest rates, but missed expectations. Net interest income rose 29% to $14.7 billion, but the increase was less than expected. Trading revenue rose 27% year-on-year, beating analysts' expectations of 13%, and fixed earning was the best performer. Our fourth quarter earnings growth was stronger year-over-year in an increasingly slowing economic environment, said Brian Moynihan, Citigroup. Traders in Citi's fixed income division, delivering their best ever at the end of 2022, are under pressure to further boost returns against an uncertain economic outlook. Clients' investments in the interest rates and exchange rates helped Citi's fixed income trading revenue rise 31% to $3.2 billion, its best performance in previous years. Total volume rose 18%, up from 10% that I predicted last month. Goldman Sachs. Goldman won't release its official results until next week, but some clues to the results of one of the bank's new subsidiaries, the company called Platform Solutions, lost more than $1.2 billion in the first 9 months of last year and fell quarter by quarter. From the beginning of 2020 to the end of September, the pre-tax losses totaled $3 billion, according to disclosure documents. Investors have been waiting for these companies to better understand the health of the U.S. economy. LPL Financial Quincy Crosby, chief global strategist, said, "Economists have heated debate over the outlook and the extent of the recession. Big banks' earnings result and their future guidance will help people understand clearly how business and consumers are doing." The CPI for December, released on Thursday, showed continued slowing inflation, prompting bold forecasts that the Fed would pause in rate hikes in March. The Labor Department reported on Thursday that the U.S. CPI growth slowed for the third straight month in December, with the unadjusted CPI falling 0.1% quarter-on-quarter, the biggest quarter-on-quarter decline since April 2020. The overall CPI still rose 6.5% year-on-year, returning to the 6 era, and the smallest year-on-year growth since October 2021. As inflation continues to slow, traders are already considering possibilities that the Fed may not even raise interest rates in February, at its March meeting after consensus expectations. After Thursday's CPI data, Fed mouthpiece Nick Timiraos wrote that the bank could continue to cut its rate hike to 25 basis points at its February meeting. CE data also suggests that the market is close to digesting that expectation. The swap suggests the Fed will raise rates at its two next policy meetings by less than 25 basis points. Market expects the Fed to raise rate by at least 25 basis points at the next meeting, from January 31st to February 1st, with a small probability of 50 basis points, meaning that there is a slim chance that the Fed will not raise rates at all at the March 21st to 22nd meeting. Bank of America strategist Michael Harnett expects a new round of declines in U.S. stocks that will eventually rebound as the economy stabilizes in the second half of the year. The analyst expects the S&P 500 to fall nearly 10% to 3,600, and then rebound 17% to 4,200. Harnett said, "It takes patience to trade during the economy and earnings recession. The painful trade will continue until the blonde-haired economy signals that high growth coexists with low inflation and interest rates can remain low." That's all I have for today. Don't forget to subscribe and like. See you next episode.